Greetings, good evening, good morning, good afternoon to all of you attending this webinar from the various corners of the world. Thanks for joining in today. Today we will have an interesting discussion on some of the key highlights of the One Big Beautiful Bill Act that was passed by President Trump on 4th of July 2025. There are several interesting changes impacting both individual taxpayers as well as business taxpayers. And we're going to be diving a bit deep into some of those tax provisions for your benefit. Today, I have with me a couple of my colleagues who will be a part of this discussion today. On this webinar today, I have with me my colleague Nikita Gulati, who's a partner with us, and Chitranshi Gupta, Director, US Taxes. The three of us today will help you navigate through some of the key highlights of this new interesting OBBBA Act. Next slide, please. Some of the areas we're going to talk about is about the expiring provisions in the Tax Cuts and Jobs Act that were made permanent. That was one of the bold promises of President Trump, some of the initial changes that he made during his previous tenure in 2017. There were quite a few sweeping changes. Some of them had sunset provisions in 2025. Some of these extensions, some of these provisions have been made permanent. So we're going to talk about some of those. There are changes impacting individual taxpayers as well as corporate taxpayers. We are going to talk about both of those, as well as some provisions which are going to impact cross-border transactions, including remittances. That is also something that we are going to cover. Next slide, please. Yeah. So just to begin with, some context, as I mentioned earlier, back in 2017, during President Trump's first regime, there was significant tax reform in the Tax Cuts and Jobs Act, or the TCJA, that Trump had brought in 2017. It was a landmark reform. It reshaped the U.S. tax system by lowering the corporate and individual tax rates. There were several new international provisions that were brought in, the GILTI provisions, the FDII provisions, the base erosion and anti-abuse tax. Some of these provisions have undergone changes in the OBBBA regime. The last month, the month of June, was quite interesting for us as tax professionals. We saw several changes happening on an almost daily basis. There were a lot of changes since the start of the House version of the bill. The Senate Finance Committee made certain changes to it. The Senate had certain versions, and finally the version that was passed by the law. As late as last week of June, there were negotiations with the G7, which led to the ultimate dropping of the revenge tax, or the 899, which we are going to also touch upon briefly. So I think with this brief introduction, let us dive into some of the key changes that this new act is going to bring about. And to begin with, we'll start with the changes impacting individual taxpayers. I hand this over to my colleague Nikita to take you through it.
Thank you, Lloyd, on the background, and a very good evening to our viewers attending today's webinar. During the webinar, we will be covering few critical tax laws changes, and not all, under One Big Beautiful Bill Act impacting the US individuals as well as businesses. To begin with, one of the most critical change, which is about the top marginal tax rates. The United States follows a progressive federal income tax system, where tax rates increase with income. The structure includes 7 tax brackets, each applying a different rate to a specific income range. Now, taxpayers with marginal tax rate, which is the rate applied to their last dollar of income, rises as their earnings grow. However, before the 2017 TCJA, the rates lowest being 10% and highest as 39.6%, the TCJA retained the 7 bracket format, but temporarily lowered the rates for individual taxpayers from the year 2018 through 2025, and the lowest being set at 10% and the highest at 37%. It also expanded the income ranges and each bracket, reducing the tax burden for many Americans. Now, new legislation has made these TCJA rates permanent, a very critical move, extending their impact beyond 2025. Additionally, the bill introduces an extra year of inflation adjustment, which affects how income thresholds are calculated for brackets above specifically 12% and between 22%. This helps ensure that tax brackets keep pace with economic changes and protect taxpayers from unintended increases due to inflation, which is commonly known as bracket creep. These tax rates are effective beginning 2026 tax year. Now, with these taxpayers between the bracket of 12% and 22 may see a dip in tax liability, but the same is definitely dependent on other factors such as standard deductions and other exemptions as applicable. So a very critical move, making it permanent forever, which is the highest tax bracket as 37%. Followed by the other important change, which is about personal exemption to senior citizens. Uh, I would say, the taxable income, just to understand, is first calculated by subtracting adjusted gross income with applicable deductions. Now, historically, taxpayers could reduce AGI using personal exemptions for themselves, their spouse, and if filing jointly, of course, and qualifying for dependents as well. But these exemptions were subject to phase out based on the AGI and filing status and adjusted annually for inflation. Now, during the Tax Cuts and Jobs Act suspended these personal exemptions in the year back 2017, reducing them to completely zero for the tax period of 2018 through 2025. Now, in exchange, the TCJA nearly doubled the standard deduction that time, simplifying filing for many taxpayers. But now, with the new personal exemption for the period 2025 onwards to 28 until, a new exemption has been introduced specifically for senior citizens, where the age criteria is 65 or older before the end of the tax year, of course, and the applicable amount is $6,000 per qualifying individual. They need to have a valid social security number reported on the tax return to claim this deduction. And definitely there will be phase out threshold also beginning, which starts at modified adjusted gross income for over $75,000 for a filing status of single and a double for the married filing jointly. There is a 6% threshold, modified adjusted gross income threshold exceeding this phase out period. And this will ultimately be effective, as I said, beginning this year, 2025 until 2022. So a good move for the senior citizens. There will definitely be some tax liability dip if they're ranging between this particular slab rate. Next slide, please. Followed by personal exemption, there's another interesting deduction which has been increased from a certain threshold to a higher 4x of that amount, known as state and local taxes deduction. Prior to the implementation of the Tax Cuts and Jobs Act, individuals could claim itemized deductions for various taxes, which included your state, local, and foreign real property taxes, state and local personal property taxes, and state, local, and foreign income, war profits, and excess profit taxes. Alternatively, taxpayers had the option to deduct general sales tax instead of income taxes. But the TCG enacted for tax years 2018 through 2025 introduced a $10,000 cap, and half of that, which is $5,000 for married filing separately filing status, on the total amount of state and local tax deductions, which only covered your income, property, and sales taxes. This limitation certainly excluded taxes tied to a trade or business and those incurred in the production of income, and also disallowed foreign real property tax deductions unless related to businesses. However, a very great move under the new bill, the SOL deduction cap will temporarily increase, not permanently, to $40,000 starting in the year 2025 itself, and will be definitely indexed for inflation, rising from 40,000 to 40,400 in 2026, and it'll keep on increasing by 1% annually through 2029 tax year. However, a very important point to note, beginning in 2030, the cap will further revert back to the $10,000 limit, which is originally set. The new legislation also introduces a phase down for taxpayers with modified adjusted gross income exceeding $500,000 as of 2025 itself, where the allowable salt deduction is reduced by 30% of the excess Maggie over the threshold. So the deduction cannot be definitely reduced below 10,000 floor, but a move for the highest individuals paying taxes, this may not be that beneficial, but definitely people earning below 500K, there will be a benefit being achieved by them. Next slide, please. Very important. This law was not in the tax section before, introduced under a newly section reform as Section 224, known as qualified tips. Under the newly enacted legislation, individuals working in occupation where tipping is customary, such as hospitality, beauty services, and food service, now can claim a temporary above the line deduction of up to $25,000 for qualified tip income. Now, this deduction applies to primarily employees who receive the tips reported on Form W-2 or independent contractors as well, getting through via Form 1099K, 1099 NEC, and could be in the, also reported from Form 4137. Now, because it is an above the line deduction, it's available to all eligible taxpayers, whether they take the standard deduction or itemize their expenses. Of course, there is again a phase out threshold, which is applicable for this particular deduction as well, starting at a modified gross income, adjusted gross income of $150,000 for single filers, and double the amount, which is $300,000 for the joint filers as well. Now, this deduction gradually phases out beyond these thresholds, and this is definitely effective again for the period starting January 1st, 2025 through December 31st, 2028. Now, an important, two cents from my end for the employer transition during this period, it is that for 2025, employers may use reasonable methods to estimate tip amounts when furnishing such required statements, because there is no specific guidance at the moment issued by the IRS. And further, this aims to provide meaningful tax relief to millions of service workers, as there is no erstwhile law pertaining to deductions of tips. So a very important move and a critical one. Next one is about the overtime compensation. Again, a newly enacted legislation. It wasn't there in the bill before. And this introduces, again, a temporary above the line deduction for qualified overtime compensation, which offers a meaningful tax relief to hourly workers and middle income earners. The key features around this particular act is the deduction amount is up to $12,500 for single filers and double the amount for the joint filers. This certainly comes with an eligibility that all the taxpayers who must be receiving an overtime pay mandated under Section 7 of the Fair Labor Standards Act, they will be applicable for that, typically where the time and a half for hours work beyond 40 per week is the case. Now, this must be reported separately on Form 2, W2, and on Form 1099 if worked through a contractors. There has to be a valid social security number to claim this. This again is backed up by a phased out thresholds, which begins at a critical modified adjusted gross income of $150,000 for single individuals, and for filers jointly filing the return, it is again the double the amount, which is $300,000. And this definitely tends to reduce as the income threshold increases. This is again effective, similar to the tips section, starting from the year 2025 through 2028. As we discussed that this is the above the line advantage and available to all taxpayers, whether they itemize deduction or take the standard deduction. This will directly reduce the gross income, making it easier to qualify to other tax benefits. The bill is certainly aiming to reward hard workers and boost take-home pay for millions of Americans. On that note, I hand it over to Chitranshi, please.
Thank you, Nikita. So now I will be taking up the other points. Next slide, please. Yeah, so this is about qualified small business stock. The qualified business stock are stocks that are issued by small businesses, and they are defined under the IRC. So here the gain exclusion limit has been increased, which was earlier set to 10 million, has been increased to 15 million now. And the and it is only applicable to all the companies that are issuing companies that have gross assets under the $75 million limit, which was earlier $50 million at the time of stock issuance. Here, the interesting thing is the graduated holding period benefit has been introduced. That means earlier where the benefit was only applicable if the holding period was 5 years, then 100% of reduction was allowed. Now it has been tiered where 50% of the benefit is allowed at 3 years, 75% at 4 years, and 100% at 5 years. So next, we're talking about deductions of qualified residence interest under Section 163. Effective January 1st, 2026, the deduction for qualified residence interest has been made permanent. The mortgage interest premium are now treated as deductible, as well as it is very similar to how interest is also being treated as deductible. So now both interest and the insurance premium would be deductible for the taxpayers. So going to the next slide, please. Moving to the next one, car loan interest under section IRC section 163C. 163 small cars. So this is basically applicable to all the small vehicles. Small vehicles, we can say personal cars, mini vans, pickup vans, motor cars, all sort of small vehicles. Previously, there was no such law or deduction of for the deduction of interest on the loan for any such passenger vehicle, which has been now introduced. The deduction limit is limited to USD 10,000. There is a phase out rule to this. The deduction would phase out by $200 for each year for every $1,000 of Maggie that has been exceeded that is exceeding USD $100,000 for single filers and USD 200,000 for married filing jointly. So this is going to be phasing out, but and is applicable from January 1st, 2025 to December 31st, 2028. So this is a benefit that is an additional benefit which has come up this year, and is going to be an interesting element for all of the people who have small vehicles and can take this deduction in their returns. So next is casualty loss. So earlier under section IRC section 165, the casualty loss reduction was only allowed for the federal declared disasters. It was very limited, so the benefit was very limited. Now this has been expanded as per the updated bill, and it is also available to the state declared disasters, which is an additional benefit for taking it on the returns. So that's the next exclusion. That's the next benefit that we are available with. Next on the row, we will talk about Trump account. So Trump account basically, Trump account is the most talked about account. Why? Because Trump has given the name, called it out by his own name. So initially, when this account came up, this benefit came up, it was called as MAGA account in the bill that was proposed by Trump. When the bill moved to the Senate after the approvals from the House, and when it moved to the desk for the signature and to be enacted as a law, it was renamed as Trump account. What's the benefit under this? So this is basically defined or designed in such a manner that it aims at growth and prosperity of the US residents. So basically, who all are eligible for it? This account is available to all US citizens that are born between January 1st, 2025 to December 31st, 2028. This account will be automatically opened at the birth, and unless parents, they opt out of it. The interesting element over here is the government has, assured amount of USD $1,000 at the birth, which would be invested into diversified stocks for the benefit in the future. The growth, the growth of the account is tax deferred exactly the same way as IRA accounts are. So that's another advantage. Here, the contributions which are made by government, in addition to that, even families or relatives or employees can also make additional contribution. That is actually, that is fixed to not more than 5,000 USDs annually to this account. So that's one. Additionally, withdrawals would work in a very phased manner. At the age of 18, the individual can, withdraw 50% of the balance, which can be utilized for education or entrepreneurship or etc. At age of 30, beneficiary has full access to the account, which means that he or she would be eligible to use the way the person intends to. So overall, this new savings account program aims to provide financial support, encourage long-term savings, and for the young U.S. citizens. And this is seen as a great benefit overall, largely. So yeah, with this, I hand it over to Lloyd, who would be taking us through, some of the other changes that have been proposed in the bill.
Yeah, thanks, Chitranshi. We'll talk about the miscellaneous itemized deductions now. These deductions were suspended by the TCJA Act. 2018 through 2025, taxpayers were unable to get these deductions. Largely, these are pertaining to unreimbursed employee business expenses, tax preparation fees, investment expenses. Unfortunately, these suspension has now become permanent. Miscellaneous itemized deductions will no longer be allowed. Having said that, there is a carve-out for educator expenses in the TCJA Act. These were capped at $250 per eligible educator. In the current version, the deduction for this has been increased slightly to $300 per eligible educator, with $600 for those who are filing joint. There's a slight expansion in the definition of educators. It now includes coaches, and the eligible expenses include certain physical education related costs. So these are some of the changes that are impacted on the miscellaneous itemized deductions. Moving on to estate and gift tax exemptions. Now, this was something that was awaited by a lot of taxpayers. Before 2017, the limit for the lifetime exclusion limit for estate and gift taxes was $5 million. In 2017, this was doubled to $10 million and indexed for inflation. The most recent limit was almost approximately $14 million. This was supposed to be, this had a sunset window in calendar year 2025. By the end of December 25, this was supposed to revert back to the original exclusion limits. So luckily, the OBA Act has made this change permanent. The new limit is going to be 15 million US dollars. There will be an annual adjustment for inflation every year, so we're going to see this amount go up higher every year from 2026 onwards, indexed for inflation. So 15 million is the new estate tax limit. What this means is taxpayers who have global estates below $15 million will not be subject to US estate duties. Taxpayers can make lifetime gifts to trusts or to their family members up to $15 million without being subject to gift or estate taxes. So this is something that's going to be used by a lot of taxpayers for their tax planning requirements, putting monies into trusts, setting up non-grantor trusts to avail certain benefits. So the enhanced limit of $15 million is going to be attractive for a lot of taxpayers. It will take out some taxpayers from the estate tax net. So definitely this is a positive move by President Trump. Can we move to the next slide, please? Yeah. Talking about the child tax credit, there is a minor increase in the benefit allowed here. The previous limit was $2,000 per qualifying child. This has been increased to $2,200 for each qualifying child. This has a refundable component of $1,400. The credit for non-child dependents is $500, and this credit has been made permanent. It's important to note that there's a very strict SSN requirement. Both the taxpayer and the dependent should have valid social security numbers that are reported on the tax return to claim these credits. The AOTC was another credit allowed for education purposes, the American Opportunity and Lifetime Learning Credits. The eligibility requirement earlier did not have SSN or EIN as a requirement, but now the eligibility requirement has been updated. And it's important that, again, to claim this benefit from 2026 onwards, the student needs to have his or her own social security number, and the educational institution will need to provide its employee identification number to ensure that this benefit is available to the taxpayer. Next slide, please. Yeah. Uh, Under the TCJA Act, there was a rollover allowed, a tax-free rollover from unused Section 529 funds. 529 funds are those used to save money for higher education, for higher college education. There was a tax-free rollover allowed for transfers to ABLE accounts. ABLE accounts are used for individuals with certain disabilities, so it is used to fund some of those expenses. This rollover has now been made permanent under the current act, and this will be effective January 2026 onwards. The next three provisions that we're going to talk about are regarding some of the clean energy credits. There's been a lot of talk on President Trump reversing, most of the clean energy credits that President Biden had introduced. The House version was quite drastic, with almost all benefits being terminated. The final version that has been passed into law on July 4th has been a mixed bag. So there have been some provisions which have been retained. Some of these which we are going to talk about have a cutoff date. So the clean vehicle and qualified commercial vehicle credits, they will not be applicable for any vehicles that are acquired post September 30th, 2025. So taxpayers do have a few months to take benefit of this. This is a $7,500 credit up to that amount. Other credits that are going to be phased out are the energy efficient home improvement credit. People who spent monies on improving their homes and making them more energy efficient could claim up to 30% of their qualified expenses. There was a cap, of course, up to about $3,200, but this credit will now no longer be made available. There's a cutoff date of 31st December 2025 for the termination of this credit. So again, few months left to make some changes and take a benefit for this taxable year. Similarly, the residential clean energy credit for new clean energy property, that was installed in their house. This also has a cutoff date of 31st December 2025. So again, a few months, 6 months left for taxpayers to take benefit of these credits. Next slide, please. Yeah, we will now move on to the other tax changes that are impacting business taxpayers. I'll hand this over to my colleague Nikita to kick this off.
Thanks, Lloyd. Next slide, please. So I will be covering the tax law changes impacting the business, but at a federal level. And for specific international tax areas, we'll hand it over back to Lloyd. To begin with, the number one change is about bonus depreciation covered under Section 168. So the Tax Cuts and Jobs Act of 2017 introduced full expensive for qualified assets. However, there were certain provisions which were originally set to phase out. Now, under the new bill, One Big Beautiful Bill Act reverses this scheduled sunset by making full expensing permanent. A great move for the smaller and mid-sized businesses. This significantly benefits all the business, allowing them to deduct the entire cost of eligible purchases such as machinery, equipment, and qualified improvement property in the year they are made. Now, the resulting reduction in taxable income enhances, of course, the cash flow, enabling faster investment and supporting growth, particularly, as I said, for the small and medium-sized enterprises. Additionally, the elimination of complex depreciation schedules will definitely simplify both the accounting and tax compliances, which will further reduce the administrative burden. Having said that this change is at a federal level, the states have not yet confirmed the same tax treatment of bonus depreciation. So before you go ahead and start filing the state returns effective period pertaining to the bonus depreciation, make sure that you are rechecking each state's status regarding this particular expensing. Because there could be a possibility certain states taking the stand alongside the same as the federal level, but there could be a hybrid approach also. So this checking from a state perspective is highly important. The next one is about the research and development expenses covered under Section 174A. The bill allows taxpayers to definitely and immediately deduct domestic research or experimental expenditures paid or incurred in tax years beginning after December 31st, 2024. However, research or experimental expenditures attributable to research that is conducted outside the United States, which means foreign, will continue to be required to be capitalized and amortized over a period of 15 years under this particular section. Small businesses, taxpayers with average annual gross receipts of almost $31 million or less will generally be permitted to apply this change retroactively to tax years beginning after December 31st, 2021. This is a very, very important point to note because this will impact a couple of the current and the future years for the capitalization done in the previous years. And all taxpayers that made domestic research or experimental expenditures after December 31st, 2021 and before January 1st, 2025 will be permitted to elect to accelerate the remaining deduction for those expenditure either within a single 1 year or split between 2-year period. So very, very important change which has come under this section. And before you finalize your tax return for 25, this needs to be re-verified that how well the expensing can be taken either in 1-year period or split between the two. Next slide, please. Now, this one is about the limitation on business interest covered under Section 163J. This section limits the amount of business interest expense a taxpayer can deduct to the sum of business interest income, followed by 30% of adjusted taxable income and floor plan interest. This was introduced by the TCJA, which typically applies broadly to businesses with exception for small entities in certain real estate or farming operations. This needed the The change is the limitation earlier was around only EBIT, but the definition has now been expanded to EBITDA, which means that it also includes earnings before interest, taxes, depreciation, and amortization. This is again a very important move for the entities which has taxable income and has business interest to claim. This increases the base for them to take the deduction for the business interest. This is effective for taxable years beginning January 2025. Last one, this is primarily around the reporting threshold for the form 1099 NEC. Earlier, this form was required to be filed when a amount is paid only starting with $600 or more, specifically to non-employee contractors or service providers. But in the recent bill, the threshold has been increased to $2,000. Starting in 2027, this will be again adjusted by the inflation annually, and there will be certain adjustments regarding the rounding of the nearest USD. So this is the only change when it comes to reporting. On that note, I hand it over to Lloyd back to cover the international aspect of the changes in the law.
Thanks, Nikita. We'll start off with GILTI taxes, the global intangible low taxed income. There have been several changes proposed in the new act to the GILTI regime. There were changes which were anyways due because of the TCJA Act. The effective GILTI rates were supposed to go up at the end of this year. So there have been changes made to this. Three changes which are relevant for taxpayers who have international CFCs, entities that are majority owned by US taxpayers, but which are incorporated overseas. So US CFCs held by US taxpayers are subject to the GILTI regime. Three changes. There has been a change in the base income that is going to be covered for GILTI. The earlier deduction that was allowed for what we call the net deemed tangible income return, which was 10% on the qualified assets, that deduction has been removed. So effectively now the entire income of the CFC will be covered for calculating the GILTI taxes. In fact, the name has also been changed to net CFC taxed income, tested income. So one change is to the base that is going to be taxable now. The second change would be the deduction that was permitted to corporate taxpayers. So corporate taxpayers were allowed to deduct 50% of this income to come at the income which would be taxable for GILTI purposes. That deduction was supposed to decrease to 37.5% under the TCJA regime, but that's now been permanently changed to 40%. So the GILTI deduction moves from 50% to 40%. And the third change is the credit that was allowed for foreign taxes. Earlier, there was a 20% haircut. So only 80% of the foreign taxes could be credited against our GILTI liability. Now that deemed paid credit has changed to 90%. So the net impact of all of these changes brings the GILTI effective tax rate from 10.5% that it was earlier to 12.6% now. If you want a zero GILTI tax bill, the international CFC should have an at least 14% effective tax rate to come at a net GILTI tax liability of 12.6%. That will enable zero payouts for companies. So any CFC where your effective taxes in your foreign jurisdiction is less than 14%, there is a likely outcome that the corporate taxpayer might end up paying certain taxes in the US due to GILTI. So again, very important for corporations who have CFCs who have been paying GILTI in the past to evaluate some of these changes. People who had a very high, QBAI or qualified business assets and who are relying on those deductions to reduce their, taxable GILTI income can now no longer rely on that qualified asset base. So definitely their asset base is also increased. What's not changed is the international blending of this income. So if there are multiple CFCs, you are still allowed to blend the income from multiple CFCs. This brings the US regime pretty close to what the OECD is trying to propose under the Pillar 2 taxes. So the guilty taxes are coming close to the income inclusion rule under the Pillar 2 taxes that the OECD is trying to implement. But again, it's a standalone version that the US is implementing. The US does not want to adopt Pillar 2 taxes in its entirety. So this is its own version of the minimum tax that it wants to apply to US headquartered multinationals. Moving ahead, please. Next slide. Thank you. The other important provision that is applicable to large multinationals, and when I say large, the BEAT taxes or the base erosion or minimum tax amount that is applicable to corporate taxpayers who have an average turnover or average revenue of more than $500 million over the last 3 years. The BEAT tax applies to large taxpayers. The current rate of BEAT tax is 10%. It was expected to go up to 12.5%, sorry, higher than 12.5, almost 14% in future years, uh, uh, between 12.5 to 14% in subsequent years. But the OBBBA Act reduced and replaced the change in the BEAT tax and brought it down to 10.5%. But one interesting provision that the Senate Finance Committee had introduced was the inclusion of a high tax exception. That would have been meaningful for corporations based out of India, where effective taxes are significantly higher in the 20-25% range. That would have meant that any BEAT payments made to companies, Indian subsidiaries or Indian CFCs may not have qualified as base erosion payments. However, unfortunately, the final version of the bill that was enacted did not have the uh, high tax exclusion. So we are down to a 10.5% rate. So there is some sort of a rate relief at 10.5%, but the high tax exclusion would have been much more meaningful for corporate taxpayers. Unfortunately, we don't see that coming. So BEAT is likely to continue having impact on global MNCs, especially those who are outsourcing work from the US to international subsidiaries. Those are the payments that are going to get covered under the base erosion taxes. So a 10.5% rate is what is now applicable. No high tax exclusion on this. The last component here is the FDI deduction, the foreign derived deduction eligible income. Again, there have been changes here. The deduction that was uh, earlier at 37.5% will now be at 33.34%, which means that the effective taxes on the effective taxes on foreign derived income would now be again at 14% because you'd get a tax break or a deduction of roughly 33% on the headline corporate tax rate of 21%. So that means the effective tax rate would be closer to 14%. Next slide, please. So we've covered some of the major business tax changes. Some of the other cross-border changes that impacted taxpayers, I'll hand it over to my colleague Chitranshi to talk about those.
So thanks, Lloyd. While we've covered some of the changes that were very implicated for individual taxpayers as well as businesses, there is something that has come up new, which did not exist, during this whole new bill proposed to getting enacted process. And these are something very critical. Why? Because they're going to be impacting a lot of outbound transactions, and that's where it's important. So this is about excise tax on certain remittance taxes. Basically, the outbound remittance transfers that are done. It is covered under U.S. IRC code 1693, What has been proposed is initially, when the bill was proposed, there was a proposed excise tax being levied of 5% on the any transfers that were made outside US. Later, when the bill moved from Senate from the House to the Senate, there was a dip seen in the percentage from 5% to 3.5%. Later, when it got moved to from the Senate to the enactment process, we saw it came down to 1%. So it's an interesting move where it applies to all the transfers that are done using physical instruments, especially all the cash remittances that are done, or money orders, cashier checks, etc. Any kind of transfers that are done by registered financial institutions are exempt, provided they comply to the anti-money laundering laws. Remittance funded via verified bank accounts are exempt again, especially if they are done, using the US issued debit cards or credit cards. So there's no tax on that. The obligation of collecting this remittance tax is on the remittance transfer providers, and they need to collect it and uh, and quarterly submit it to the treasury. Otherwise, there are bearer secondary liabilities that they will be imposed on them. So basically, it's the liability of the remittance transfer providers to ultimately make these payments. There is an anti-conduct law rule also designed to prevent any tax avoidance by routing the transfers through the indirect channels, whatever there is any kind of indirect channel transfers that are happening. This is basically to safeguard. So all of these unsolicited transfers that are happening. Next slide, please, Bible. So next is about this is an interesting one where initially there was a revenge tax basically introduced, which of course was withdrawn later when the when the bill got enacted. Under this, there were basically this is basically enforced against the unfair foreign taxes. It was introduced to counter the all the unfair foreign practices that were happening around. The mechanism involves using US tax rates in 5% steps for affected entities until the foreign tax is removed, and the rate reaches 20% above the statutory rate. The provision applies to the foreign governments, resident individuals, corporations, private foundations, entities owned by such persons. It is also expands the beach regulations basically for the US entities owned by residents of the such jurisdictions. Um, However, the provision was withdrawn due to, there was a lot of opposition from G5 nations, due to which the regulation was withdrawn. And the most important thing, I think, all of us should, as taxpayers, be mindful and we should watch out is there might be chances of this coming in future. So we should, keep a watch on that. With that note, we have covered all the major changes that have come in the bill. We will move forward and now take some of the questions that we have. Please note, if you have any questions, do post it to us on the chat, and we will try to cover as many questions as we can. If we are not able to, we will surely revert to you in person for all the questions. So, first question that I would take is so Lloyd, first question to you, probably I would say, what is your sense of the new law? Does it benefit the American rich or middle class? Any changes to the estate on inheritance law? inheritance tax?
Yeah, so I think this is a bill that has expanded a lot of the tax cuts that was introduced by Trump in 2017. If you look at the tax cost of this bill, I mean, it's close to about $4.5 trillion in tax cuts. It is going to add roughly 3.3 million to the US, 3.3 trillion, sorry, to the US debt. So in that sense, these are sweeping, tax cuts, and these were very, very narrowly passed in the legislative houses as well. It passed in the Senate by a single vote, and that too, it was a tiebreaker vote, from the vice president. So again, it does favor a lot of the earning or the working population, the lower middle class, I would say. The tax on tips, the overtime tax paid, all of these are targeted towards the lower income taxpayers, at least the tax rate changes. As we move up the tax bracket, all of these provisions typically get phased out. So the benefit on tips, the benefit on overtime pay, these generally get phased out when once you reach higher income levels. The estate tax exemption, the increase in that will benefit, I would say, larger taxpayers as well, because it was supposed to, sunset and revert back to an effective rate of about 7 million odd at the end of 2025. So, in a sense, that's doubled. We were looking at a 7 million lifetime exclusion for 2026. That is now 15 million. So definitely taxpayers who have global net worths in those ranges have been benefited. So it is a mixed bag for those who are relying on the clean energy credits. Perhaps there's been a disappointment. A lot of that has been rolled back, some certain clauses there as well. So I would say it's been a mixed bag. It is positive for certain corporate taxpayers who are looking to invest and manufacture in the US. On the international tax side, on the cross-border side, I don't think too much of relief is available. Guilty tax rates may go up slightly, BEAT will go up marginally. So not much relief there. We were hoping for some changes in the corporate tax rate. In the last, reform, there was a significant cut in the corporate tax rate, down to 21%. Trump's poll promise at that time was 15%. So in some quarters, we were hoping to see perhaps some bips to be reduced in the corporate tax rate, but that was not to be seen.
Thank you, Lloyd. Next question, Nikita, for you. What is the effective long-term capital gain tax for 2025? Has there been any change in OBBBA tax?
Chitranshi, there's not been any change when it comes to long-term capital gain taxes. It is still the same 0, 15, and 20% given as per the income thresholds. And there's no change again on the Obamacare tax as well.
Yeah, it will remain the same. There's no change to the NIIT, the 3.8% surcharge. No changes have been made to that.
Okay, so we have one more question that I see for individuals. Lloyd, to you, I'll post. For individual tax deductions, for most of them says that it will expire in 2028, 2020, and 2029. It means after these dates, tax rates will be back to old rates. Is that something that we can imply
Yes,
from
so
this?
I think it's a similar model. In order to balance the budgets, they had to keep a sunset window on some of the tax cuts that they have done. So not all the changes are permanent. Some of the changes that have been made have a sunset in 2028 or 2029. So yes, that does mean that unless future governments, make those changes permanent or, extend the sunset on some of those clauses, we will revert back to the earlier rates.
Okay. Next question is on beat. And this is it's asking, since High tax exclusion is not available. Is there any way to negate the impact of BEAT? Lloyd, would you want to take this
Yeah,
question?
I think the high tax exclusion is something that is definitely causing a heartburn for a lot of corporate taxpayers impacted by BEAT. Having seen the similar relief available on the guilty taxes side and the inclusion of that exemption in the earlier version, which the Senate came out in middle of June, it definitely raised hopes amongst large corporate taxpayers. Unfortunately, it's not made its way to final bill. So there are various ways in which corporate taxpayers need to structure their transactions to avoid or to minimize the impact of BEAT. If you can contract directly with the Indian companies, Indian parents, that's one opportunity. There are certain exceptions that are available uh, under the BEAT regime. There are certain exceptions for low margin services. There is something which we call the SCM exception. So those will have to be explored. Again, these are very specific fact-based analysis which may need to be applied to for corporate taxpayers. So definitely the tax rate is a relief, but in order to improve upon the effective BEAT taxes, you will have to look at some of the specific exceptions that are laid out and that are applicable in your case. Yeah.
Thanks, Lloyd. So with this, we have covered most of our questions. I would request Lloyd to, just help us,
Sure. Thanks, Sukhanshi. I think, as I said, earlier, the provisions are a mixed bag for corporate taxpayers as well as individual taxpayers. On the personal tax side, on the individual tax side, there is a relief on the tax rate. Some of the salt cap deductions have increased. There are benefits on QBI deductions. So several provisions that impact corporate taxpayers. But I would say most of the individual taxpayers. But most of the benefits have been on individuals, I would say on the lower income brackets, not so much for individuals on the upper end of those tax brackets. So other than perhaps the QSBS exclusions that would be beneficial to startup founders and other business owners, and the increase in the estate tax exemption, I think those two would be the headline benefits for individuals in the top marginal tax breaks. On the corporate tax side, people who are investing and buying assets, doing manufacturing in the US, I think there's definitely a positive in terms of the bonus depreciation, the expanded 179 depreciation. Those are some of the benefits that corporate taxpayers will definitely look forward to. The changes in the 174 research and experimentation deductions are also welcome. I know there was a lot of furore a couple of years back, especially 2022 onwards, when there was a change in the deduction ability for research expenses. Now that has been restored, at least for domestic R&E expenses. Now corporate taxpayers can claim full deductions and do not need to amortize those. Foreign R&E expenses, unfortunately, the amortization rules still continue. So corporate taxpayers, I think there is a lot to look forward to. The changes in the interest deductions, the 163J rules, the expansion of the limits from EBIT to EBITDA also has been positive for corporate taxpayers. Not too many, I would say, surprises on the international tax, although there could have been slightly better changes, but unfortunately, there's not much of a relief on the cross-border changes. Having said that, there's not too much adverse as well. Unlike what we saw in 2017, the tax bill of corporates went, skyrocketed with guilty taxes being applicable, transition tax was payable, BEAT taxes becoming applicable. So luckily, no new taxes for corporate taxpayers. So that, in a sense, is sort of a sense of relief for corporate taxpayers. So overall, I think a mixed bag for both corporates and individual taxpayers. Hopefully, we'll see some more clarifications in the days to come. So I think with this, we'd like to wrap up today's conversation. Thank you very much for all of you who tuned in to this webinar. Feel free to reach out to us if you have any additional questions. We'll be happy to revert. In case we haven't reverted to any of your questions, the Q&A, our teams will get back to you. Thank you, and you have a good day.
Thank you, everyone.
Thank you.
Thank you, everyone.